Welcome back to our channel. Today we're diving into a mortgage option that sounds appealing but comes with some big risks: interest-only loans. If you've ever wondered how they work, who they're for, and whether they're a smart choice, stick around because we're breaking it all down in detail. What is an interest-only loan? An interest-only loan is exactly what it sounds like. For a set period of time, usually 5 to 10 years, you're only required to pay the interest on your mortgage, not the principal. This means your monthly payments are much lower compared to a traditional mortgage during those early years. For example, let's say you borrow $300,000 at a 6% interest rate. With a traditional loan, you'd be paying both principal and interest each month, maybe around $1,800. But with an interest-only loan, your payment might be closer to $1,500. That's a big difference up front. Why people choose interest-only loans? So why would anyone want an interest-only loan? Lower initial payments: it makes homeownership more affordable in the short term. Flexibility: if your income is irregular, like for business owners or commission-based workers, having smaller payments gives breathing room. Investment potential: some people use the savings to invest elsewhere, hoping their investments grow faster than their home equity would. Short-term ownership: if you plan to sell the home before the interest-only period ends, this can keep costs low without worrying about big payments later. The risks of interest-only loans. But of course, there are risks. Payment shock: once the interest-only period ends, your payments jump significantly because now you must pay both principal and interest over a shorter time frame. No equity build-up: you're not paying down the loan balance, so unless your home value rises, you don't gain equity. Housing market risk: if property values fall, you could end up owing more than the home is worth. Harder to qualify: lenders often reserve these loans for borrowers with excellent credit and strong income, because of the higher risk. Who should consider an interest-only loan? Interest-only loans aren't for everyone. They may be suitable if you're a high-income earner with fluctuating cash flow. You know you'll only live in the property short-term. You have a solid financial plan for when payments increase. You're disciplined enough to make extra payments toward the principal even during the interest-only period. On the other hand, if you're a first-time homebuyer planning to stay in your home for decades, a traditional fixed-rate mortgage is often safer. Alternatives to interest-only loans. If the idea of low initial payments appeals to you, but you're worried about the risks, consider alternatives. Adjustable-rate mortgages, ARMs, these may offer lower rates initially, but can adjust over time. Longer fixed-term loans: a 30-year fixed mortgage spreads payments out and keeps them predictable. Making extra payments: with a traditional loan, you can still choose to pay more when you have extra cash, effectively creating your own flexibility. So, interest-only loans can be a useful tool for the right borrower, but they're definitely not one-size-fits-all. If you're considering one, think carefully about your long-term financial goals, your risk tolerance, and how you'll handle that big jump in payments down the road. Would you ever take an interest-only loan? Let us know in the comments below, and don't forget to subscribe for more mortgage and finance tips.